I don't think Wall Street wants us to know that we can self-direct because they don't make money from it. When you self-direct an IRA, you're not investing in Wall Street per se, you're investing in Main Street. You're investing in things like cryptocurrency even, or precious metals, or you're investing in houses, you're investing in syndications, you're investing in notes, buying performing and non-performing debt, the whole alternative asset space. That's not Wall Street. But the thing that really shocks most people is that you've been able to self-direct for 50 years now.
If you're listening right now, chances are you have money sitting in a retirement account, maybe a 401k, maybe an IRA, and you've been told your only options are mutual funds and stocks. Today's guest, Kaaren Hall, is the CEO of uDirect IRA Service. She has helped investors move over $1 billion or more into self-directed IRAs, showing them how to break free from Wall Street's menu and build real wealth their way. Kaaren, welcome to the show.
Thank you so much. I really appreciate this. This is great.
So let's just dive into it. Most people have heard of IRAs, but the term self-directed IRA still confuses people. I honestly didn't know what a self-directed IRA was up until a few years ago. What does Wall Street not want people to know about IRAs? Can you break it down for us?
I don't think Wall Street wants us to know that we can self-direct because they don't make money from it. When you self-direct an IRA, you're not investing in Wall Street per se, you're investing in Main Street. You're investing in things like cryptocurrency even, or precious metals, or you're investing in houses, you're investing in syndications, you're investing in notes, buying performing and non-performing debt, the whole alternative asset space. So that's not Wall Street. But the thing that really shocks most people is that you've been able to self-direct for 50 years now. Yeah.
I had no idea. 50 years. It's so
Right?
crazy. A lot of people I talk to don't even know that
Yeah.
you can do that.
It's so crazy. So 1975, the ERISA Act was passed. It's an acronym, of course, the Employment Retirement Income Security Act. Okay. Gerald Ford was the president then. You weren't even born. So there you go. And that's when IRAs happened. And when they happened, when they were created, since day one, you've been able to invest in anything except life insurance contracts and collectibles. Everything else is okay, alternative assets, pretty much, with some exceptions, which we could get into. But self-directing is just not new. It's just that not a lot of people know about it. I think it represents maybe 4% of the overall retirement, the IRA market.
It's crazy because it's not something that they teach you in the traditional sense where, you watch shows like Dave Ramsey and Susie Orman on TV, and they're not talking about these things, but it is a huge way to build wealth and do very many lucrative investments outside of the norm. What do people need to know? What kind of questions should they be asking? What should they be looking out for?
With the self-directed IRA, you need to have the right expectations. If I go to my financial advisor, who's a CFP, she's got all this education, all these licenses, and I say, hey, I would like to open an IRA, I know that she's going to handle it. It is handled, okay? With the self-directed IRA, we handle some of it, but it's self-directed. You're handling more of it. You're considered the financial advisor yourself. So you've got more power and more choice and more responsibility. So it is your job, first off, before you open an account, to choose an asset and to do your due diligence to learn about various asset classes, different things, real estate, private equity, precious metals, cryptocurrency, different asset classes, and decide what you're interested in. What do you know best? We say invest in what you know best. Then open a self-directed IRA and use it as a vehicle to invest in that asset class that you already understand, that you've already researched. So the first step is know your asset. Then opening an account is just crazy easy. We have a digital form. It'll take, 10 minutes. It's not a problem. You have an IRA. The next step is to move money into it. And now you give us the documentation for the asset that you want to invest in. Now, the IRA is the investor, and it's not the person necessarily. It's the IRA account. So the IRA account name is the name of the investor. So we review that, and assuming there's no big problem that we see, we'll fund that deal. Now your IRA has self-directed. And then all the proceeds that are due to the IRA go back in the IRA that owns the asset. And that's sort of the life cycle of the self-directed IRA. But The most important part is knowing the asset.
Can someone open up a self-directed IRA if they're working a W-2 job and a regular job? Can anybody just open up one?
Yes. I mean, you have to have earned income to contribute to a job. So it's a pretty, or to contribute to an IRA. I mean, earned income from a job to contribute to an IRA. So it's a pretty low barrier to entry. It really is just earned income from a job is all you need to qualify to open an IRA and therefore a self directed IRA. But you choose a self directed IRA because you're specifically looking at alternative assets.
There's also a solo 401k, right?
Mhm.
And then so what's the difference between the 2? Is it just kind of the same idea between except you are self-employed?
Yes, it is. And so self-directing refers to the asset class. And when we talk about the solo K versus the IRA, now we're talking about different account types. So you can self-direct a Roth, a traditional, a SEP, a simple, a spousal, an inherited IRA, and you can self-direct a solo 401k. So that kind of account is for a business owner who has no full-time employees in any of the companies that they own. Just no full-time employees. You can have some part-time employees, but no full-time employees. So a solo 401k is structured the way a 401k is, say, at your job. But in this case, you're the employer and the employee. So a 401k has two parts, the plan and the participant. So the plan represents the employer contribution, the participant represents the employee contribution. And so all told together, you can contribute a max of for 2025 of $70,000. That's the most you can contribute. So you have your competent tax professional help you calculate that contribution for you based on your income. But it's a great account because it has so many bells and whistles. Like the employee part can be Roth. Also, you can take a plan loan. You can't borrow money from an IRA for more than 60 days, but you can take a personal plan loan from a solo 401k. And what that looks like is you can borrow the lesser of 50% of the account value up to a max of $50,000. So, like that. So, say you took out a plan loan of $50,000. Great. You borrowed money from yourself, really. And now you're going to pay that money back to your plan. Instead of going to a bank and paying a bank interest, you're going to pay yourself the interest because you're going to pay that loan back to your own IRA, to your own 401k, I should say, over a 5-year period in either monthly or quarterly payments at a market rate, which is like, I don't know, prime plus one or something like that, right? So you pay yourself back over 5 years, but then now you've got this big chunk of money and you can use it for personal use. Typically with IRAs and with anything self-directed, nothing is for personal use. But this is the one exception where you can actually have the solo 401k loan and use it for personal use. Maybe take that 50 grand and send your kids to college, buy a personal home you're going to live in, go on vacation, whatever you wish to do, but you're paying your plan back. So that loan ends up being an asset of the plan and you're building your own future, your own wealth.
That sounds like massive, massive tax savings. And then you're basically loaning to yourself and you're paying yourself the interest
Yeah.
instead of giving it away to the bank.
Like you're the bank. It's so great.
Exactly. That's so awesome. What I want to know is how can someone buy a house using their IRA?
Yeah, so you can buy a house and it's the same way that your IRA would acquire any other asset, really, except it's a house. So we know we've all, kind of gone through that process. It's buying a house. But when it comes to funding that purchase, it's funded by your IRA. Now, it might be possible that your IRA would borrow money to buy that house. There's this very special kind of loan that an IRA would take, and it's not the same kind of loan that you and I would take to buy the house we're going to live in. So first, the IRA can only buy a rental property. It has to be non-owner occupied because the assets in a self-directed IRA have to be like arm's length. So you can't have personal use. So first off, it's a rental property. And secondly, if you need a loan, it's going to be what's called a non-recourse loan. It's not a loan you go get from a mortgage loan officer. It's not a Fannie Freddie kind of a loan. It's like a commercial loan.
So that means you're not personally liable, right? When it's non-recourse?
Yeah. When it's non-recourse, you're not personally liable. Exactly right. If your IRA doesn't pay the loan back, the lender can come against you. I'm not you again, not against you personally. I'm sorry to say, and also not against any other assets in the plan. They can only come against the house, the underlying asset. That's it. So they can't come against you. They can't take anything else that's in your IRA. They can only recall or take possession of the property in the case of non-payment.
What are, say, like top 5 investments you've seen lately in the self-directed IRAs? What are people investing in?
Right. When it comes to categories of assets, like asset classes, there are maybe a dozen. It's not like 100. There's a limited number of asset classes, but the number one asset class for our whole industry is private equity. And what I mean by that is like a Reg A, B, C, or D offering, also called a syndication, private placement. It's called different things, but it's when somebody has gone to the SEC, they have permission to raise capital. They do this under a structured format. And then they're regulated by the SEC on how they raise capital. But they're going to raise capital and acquire an underlying asset, which is typically real estate, like maybe a strip mall or a multifamily building or something like that. So that's the number one asset class, investing in syndication.
So they'd invest in the syndication with their IRA, not themselves, but it would be under the name of XYZ IRA.
Yes, exactly right.
And so it's its own entity in a way,
It
right?
is.
And they can even buy like crypto.
Yeah, crypto is huge. I think that would be number two. Syndications are number one. Crypto is number two because it's just so on the precipice of, it seems like, of going somewhere. It seemed like that for a while, but crypto is very hot right now and it's the number two asset. And then number three asset would be notes, where the IRA is lending money to someone else, secured or unsecured.
Is there anything that's prohibited? What's a prohibited transaction?
That is how you win the self-directed IRA game. I call it a game of keep away from prohibited transactions. So you keep away from having personal benefit, present benefit, indirect benefit from your IRA. The IRA is only for retirement benefit. What that means is that you, for example, would not buy a house with your IRA and live there. Then you would be having personal benefit from your IRA today. That's not okay. But you also need to know that some people are disallowed to the IRA, and they're your ascendants and descendants, your parents and grandparents and their spouses, you and your spouse, and your children and your grandchildren and their spouses. So your IRA, for example, could buy a house and your uncle could live there, right? But not your dad.
Oh, interesting. How about my brother?
Yeah, your brother's
Okay.
okay. Your brother could,
Ah,
but not your son.
interesting.
Disallowed or up and down the family tree. Think of it as if you passed away without a will and someone was going to disperse your estate, how would they do that? They would do that looking at your ascendants and descendants. That's sort of a way to think of it.
Okay, so there's a story about Peter Thiel. Do you know Peter Thiel's story?
Yes.
He invested in, say, the 90s. For anybody who doesn't know, he's the co-founder of PayPal. I think we all know what PayPal is. And he took his self-directed IRA, I believe, and invested $1,700. And he bought shares of PayPal. Long story short, I mean, that has grown to billions of dollars. We all know what PayPal is. And legally, that is tax-free
Because I think he bought it with the Roth
with the Roth. Yeah.
And when he did that, and when it became big front page news, it created this giant investigation by the Department of Treasury. And the Department of Treasury decided they were going to dig and find out, let's look at these mega IRAs. And not many people have mega IRAs, as it turns out. So what they learned is there are maybe 400 people that have multi-million-dollar IRAs. And most of them are doing it perfectly within the limits of the IRS tax code. There are very few infractions there. So they were thinking maybe it was they could find infractions and they could find these people or set the record straight. But no, most of these people were following the rules. And that was what was so great. But they spent millions on this investigation. And I don't think they came up with much at all.
But can someone legally still do that today? Buy private shares and grow billions in their account?
Yeah, it's all legal. There is no cap on how much your IRA investments can earn. There's just no cap. There's a cap on how much you can contribute, from your own checking account every year. But there's no cap on earnings. Washington has talked about capping earnings, but they've never done it.
So what happens if someone does break some rules with their IRA? What's the craziest thing that you've seen?
When you commit a prohibited transaction, another thing you can't do, another prohibited transaction is offering services to the plan. So here's what that looks like. Say you're a GP, a general partner, and you're raising capital for a deal. You're not going to put your IRA money in your deal. Typically, GPs like to co-invest with their investors, but not with your IRA dollars, because as a GP, you would make two prohibited transactions. One is you would be offering services to the plan just with your intellectual property. And then you would be receiving personal benefit because you're literally getting paid from that deal. So that would be a prohibited transaction. So there's an example.
Okay. So if you have a deal, you can't invest in your own deal with your self-directed IRA.
Correct. Because it's not arm's length and you would receive personal benefit. It's a prohibited transaction. That's right.
So what's the craziest investment you've seen someone do? Legally,
Yeah.
not illegally.
No, I mean, we don't, if we think it's illegal, we won't fund it, well, if it looks that way. And it's pretty easy to see. A very long time ago, I worked for a different self-directed IRA company and a young man invested his Roth IRA and bought Super Bowl tickets.
I was gonna ask about that. I saw a post about that. I'm super curious. How did that work?
Okay, I'm going to tell you that post has over 3.5 million hits as of today. People are flipping the heck out. Like, you can't do that. She doesn't know what she's talking about. It's so awesome. I do know what I'm talking about. I wrote a blog article about it. If you want to go deep, go to uDirectIRA.com, read the blog article. So his IRA purchased tickets. Okay. Now, these tickets weren't collectibles. So check that box, not a collectible. His Roth IRA acquired the tickets and then he resold them at a profit. Similarly, I could buy a house and sell it at a profit.
But what was special about the Super Bowl ticket? Is it just because you can just buy anything?
Pretty much. Now, some people say, well, the Super Bowl ticket was a collectible. It wasn't. And at that time, what you would do is really first you'd buy a lease, and that lease would allow you to buy the ticket. So it was kind of like really so there was kind of like a tier thing. He bought these tickets and resold them and had the profit in his Roth IRA. And this was a long time ago. It was not an active trader business because it was a one-time transaction. So he doesn't break that rule. Again, I recommend you go to our website and check out that blog article. But that is the craziest thing. People love that story.
Super good. That's super good. Is there any sneaky legal loopholes that that are totally legal that is interesting that you could share with our listeners?
Yeah, everybody wants a hack, right?
Everybody wants a hack.
It's so true. So no, don't mess with your retirement money. These are precious dollars. It's hard to save. You set this money aside. Don't do risky stuff in your IRA. What you want is a just quiet, boring investment, in my opinion. Do what you want, but this is money for your future. So, is there something that you can do that's a little on the sly? I don't think that way. So, nothing is coming to mind immediately. What you can do is you can lend money to other people. You can buy performing and non performing debt. You can buy real estate and, buy and sell real estate, factoring, or like, say, for example, a doctor's office, they have a lot of accounts receivable, but they need cash now. So they'll sell the right to collect that debt to someone. That's called factoring. So an IRA can typically do that. Now, technically, an IRA could buy a racehorse, but it has to be
Oh,
administratively
wow.
feasible. Yeah, it's an asset, like a Super Bowl ticket. But the IRA custodian gets to choose what assets they will and will not custody, what is and what isn't administratively feasible for that asset, for that custodian. Some assets, I keep wanting to say asset holders, some custodians will not allow racehorses, but some will. So that is another thing you could possibly do. That's kind of crazy and off the beaten path. But I don't think I wouldn't try to get past the IRS because here's what happens when you commit a prohibited transaction. You've got this tax protected bubble of money for your future, by the way, for your future, for yourself. Don't hurt yourself. And if you commit a prohibited transaction, that bubble bursts. And now that money is no longer tax protected. Now you're getting taxed on that money. You're getting, and possibly excise taxes, penalties, and you're just in a worse situation. So the point of a self-directed IRA or an IRA in general is to save and be in a better position. So I would not be playing fast and loose with those dollars if what you really want is a secure financial future.
Going back to lending, because real estate investors are always wanting to know about lending. How would one lend out? What's the proper procedure to say someone doing a fix and flip on their home and they want to borrow money?
Just say it's you and me. You're building a house. I have an IRA. Maybe you're all the way almost done, but you just need like an extra 20 grand for the kitchen or something. Like, something blew up and you need an extra 20 grand. I have an IRA. I'm your friend. And it's like, hey, my IRA can lend you the money. And then because you've already got your debt probably on the project and you don't want to go take out another loan, it's just 20 grand. My IRA lends you money. Now that can be secured against the property. Say it is. So say I lend you money. There's a security instrument, part of like a deed of trust that gets recorded. And then when you sell that property, my IRA gets paid back from the closing costs. And so that's how it works. So we would come to terms. It would be a legal rate, which is to say, not usury. Usury, of course, means charging an illegal rate of interest. So it would be a market rate, a common rate. And then you would pay my IRA back on the terms that we agree upon, as long as they're legal. It's an agreement between parties. So my IRA lends money to you for your project, then you pay my IRA back that debt, either monthly payments or in a lump sum, whatever is agreed.
You can set the loan for like 15 years if you wanted to, 20 years, 30 years. Or is there a cap?
There isn't a cap, but what we want to see to make sure it's truly an investment is that at least interest only payments are made at least quarterly. People used to do this. This used to be a kind of a scam where someone would say, hey, make a loan to me. It'll be a 15-year balloon. Well, 15 years is a gosh darn long time. So 15 years have passed. And what they would do then is they would extend the loan. But wait a minute, it's been 15 years and I haven't received a penny back and we're going to extend the loan. That's not really an investment, is it? You haven't received anything in exchange. So before we're going to fund a loan like that, we want to see that the account holder is receiving at least interest-only payments at least quarterly.
Why do you think your normal financial advisors, say your Northwestern Mutual, your Fidelities out there, why aren't they talking about self-directed or helping people to do these types of plans?
Because they don't get paid on it. They get paid on assets under management, and a self-directed IRA would not be under their management. Their licenses wouldn't allow them to recommend alternative assets. So that's not their wheelhouse. And so they don't make money doing that. So they would not recommend it, typically, is how it goes.
And they make a pretty penny. I learned the hard way. They're stealing like 1% or more of your all your money every
Whether
quarter.
you make money or not, that's true.
Whether you make money or not in fees. Yeah, exactly. What is the worst investment that you've ever seen someone do?
I think when people find an investment, it looks good going in, and that's why they've invested. Lots and lots of investments have blown up for a variety of reasons, and some have nothing to do with the party. Sometimes it's things like they call it a black swan, like where rates go up or something, there's a problem. So, but I think one of the silliest things I've seen, and it actually happened twice in 1 week. It's sort of a coincidence. We had two different lawyers who didn't know each other, who used their IRAs and bought houses. Each of them did this. Each of them, within about a couple of weeks of each other, had their renters pay the rent not to the IRA, but to themselves. So they took personal possession of their IRA profits. That is, you don't do that. That at the best, that is a distribution from your IRA and it's taxable. At the worst, it's a prohibited transaction. So you never take personal possession, the proceeds from your IRA owned assets. And in fact, if you get a check or a wire and it's sent to you personally, you just call that asset sponsor, said, hey, you made a mistake. Say that, please recut this or reissue this wire to the correct payee. You sent it to the wrong payee. And just let them fix that because you don't take personal possession of IRA funds.
So everything needs to be made out. Like if you're writing a check, everything needs to be in the name of the IRA, not your personal name,
Exactly. Yes.
or else it's considered a distribution. And an early distribution, that penalty is what, like 20,
10%.
10%? And then you have to pay, I think, the income tax for your state for that, right?
Well, federal and state.
Federal and state. Comes out to a pretty penny.
It does. It's not. Yeah.
It's not worth it.
Mistakes happen, but of course, when you invest, you're going to take a careful look at this deal. We're going to look at your documents and we're going to look through too. I mean, the onus is on the account holder to make sure that it's a good deal, to make sure it's solid, that they've invested with a credible person, because we're not recommending that investment advisor or that opportunity to people. We don't sell assets. That's why it's self-directed, because the account holder is choosing the asset themselves. So the responsibility to do it correctly is always on the account holder. But we are going to look at the deal. And if we see something, we'll say something.
I'm going to jump to some advice. What advice would you give to a 25-year-old? Would you say it's a good idea for them to open a self-directed IRA if they had money?
Yeah, I have a 25-year-old.
You do? Did
Yeah.
you tell him to open a self-directed IRA?
I have a son and a daughter. I opened Roth accounts for them when they were young. They were employees of uDirect at the time, so they would use the income from uDirect. It turned into the contributions for their Roth IRAs. So I started Roth IRAs for them because now they have tax-free growth. Another thing with the Roth IRA that most people don't know is there's such a thing as a Roth clock. Like, what is a Roth clock? In order for the Roth money to be tax-free, you have to have had a Roth for at least 5 years. So if you're 75 years old and you open a Roth today, you have to have that Roth for 5 years before the money comes out tax-free. So you'll be 80. So just start that Roth clock as early as possible. So that's what I did for my children. They worked for the company, they did marketing, they were very helpful. Both my children have jobs and they continue to contribute to their Roth IRAs. Now, neither one of them is in a position to self-direct. They have jobs, they're not focused on alternative assets. It's hard to admit that they are not real estate investors yet. Well, actually, my son is. My son really is. So that's, I take that back. My daughter isn't yet, but she will. She could self-direct. But when you're going to invest in something large like a house, usually you have to be a little older or have a little more time because maybe you've had a couple of jobs and you've rolled over the 401ks from your previous jobs and now you've got a sizable IRA that you can use to take down a big asset like a house or have 50,000 in there to invest in private equity. So typically it isn't the 25-year-old that has that, but at 25 contribute and save money and just don't touch it. That's what I would recommend.
Back to your kids. I was curious when you said you had them work for you when they were
Yes.
kids. How old were they? I know that people talk about that as kind of a tax hack to have your children work for you and save taxes that way, but also obviously you're growing their wealth by having a Roth early on as well.
It's true. Amanda Hahn is my CPA. She's a great person, and so she would use my children as examples when we would speak together often, we go out and speak in front of audiences, and she would love to use my kids as an example before she had kids of her own, right? And how Kaaren has hired her children, and they're on payroll. So, right, they would help me with marketing, and they would do the check-in desk at events, and they would help me with marketing. I used to market with postcards, so they would they're sick of it now. They like to tease me about it now, but they would stamp postcards and label postcards, quite a number of them. So they worked. I put them to work and they earned money and that money went in their Roth IRA.
So smart. So smart. I'll have to look at doing that for my kids. Start young, right? Earlier you start, the more wealth obviously that you'll build. So
It's so true. Yeah.
yeah. So let's talk about what's in 2025, the one big beautiful bill. There's some changes and give us a lowdown.
The changes are for 401ks, not yet for self-directed IRAs. This is very positive for the self-directed IRA industry, but what was signed, it will allow 401k plans to include alternative assets. What these would be was sort of like funds. So an IRA could invest in a fund that holds alternative assets. So it would work like this. Typically, to invest, say, in a syndication, you have to be an accredited investor. The way this would work is that the plan would satisfy the accredited investor status and the plan would invest in the asset. And then an individual, even who is not accredited, could invest in the whole. Do you see what I'm saying? Kind of like a mutual fund. So the plan buys the asset and the participant invests through the plan in a group of assets. So it's early days. We'll have at least a 180-day review period for the Department of Labor, the DOL, as they review the fiduciary ramifications of this. And here's what I mean. I have a 401k for my company, and any 401k and any administrator or trustee of a 401k plan is responsible for the assets and can actually get sued. So the Department of Labor is going to look at the fiduciary status of the plan trustees and probably try to indemnify them in some way that they can invest in these alternative assets. And there has to be some indemnification. Otherwise, 401k plans won't offer risky assets. So this passed, it did, but it's going to happen at the speed of government, I like to say.
Mm.
So it's at least 6 months for the DOL to do their fiduciary review, and then we'll see what comes of this. For example, at the end of 2022, right? So December 31st, 2022, the Secure Act 2.0 passed. Great. What was great about it is it allowed Roth-like contributions in SEP and simple IRAs. Like, what? Yeah, you can contribute up to $70,000 if you qualify in a SEP IRA if you're a self-employed person, right? Crazy. Who knows that? Almost nobody. Why? Because the Department of Treasury took forever to come out with any guidance. We couldn't allow these contributions when we had no guidance. And we still don't really have adequate guidance. Making Roth contributions to SEP IRAs is not very popular yet because there are still some unanswered questions. So this is something that happened at the end of 2022 that the government has not yet finalized. So we'll see how long it takes this aspect of the big, beautiful bill to come to fruition.
They're eligible to invest into a SEP IRA, though, at this point, right? Or is it not clear yet?
Right. So a SEP IRA is for self-employed people. You can absolutely open a SEP IRA and make a pre-tax contributions, that maybe you'll get a tax deduction for. You can make Roth contributions now. That is okay. Can you contribute to a SEP and a Roth IRA? We need clarity from the Department of Treasury. I belong to a group called the Retirement Industry Trust Association. We go to DC, we talk to the IRS. Please give us guidance. And they have a lot of things on their plate. And there have been, with the new administration, some cuts. So this may not be the top of their stack of work to do. So we're still waiting for complete 100% guidance on this.
Okay, so it might be a while.
But you can make a Roth contribution to a SEP now, today.
Is there any other big news floating around for 2025?
We had a lot of excitement before with the Secure Act 1.0 and 2.0. That, going back a few years, changed a lot of things about increased the RMD age, the required minimum distribution age. So when you're in your 70s and you have to take the money out, it was 70 and a half, and it was raised with Secure Act 1.0, raised with Secure Act 2.0. Now it's 73. So it went from 70 to 73 because we live longer. So there was a lot of change a few years ago. IRAs are an area where the government is looking to make a lot of change. And so no change is good. But I think this big, beautiful bill, when it comes to fruition, assuming it goes as hoped by the government, that it will be a good thing for savers. They'll have more choices. It will be a good thing for the self-directed IRA industry because it will make alternative assets more mainstream. So I think it's a very good thing.
Really good thing. People should have more choices. People should invest in what they want to invest.
I agree 100%.
I heard you wrote a book. Tell us about it.
I did. Thanks. Yeah, this year I wrote a book with BiggerPockets. I happen to have a copy. So here it is. It's the BiggerPockets Guide to Self-Directed IRA Investing. And so we came out with this in January of this year. It's a guidebook, it's a how-to on self-directing, really easy to read. And it goes through all the things we've been talking about here today about how to open a self-directed IRA, what are the rules, what's the history of retirement, what are the pitfalls, and how do you invest in assets like real estate. It's on Amazon. It's also on biggerpockets.com/SDIRA.
Sounds like it's the Bible of the self-directed IRA. Must get if you're investing with your self-directed IRA. Well, thank you so much for your time today, Kaaren. This was so much good information. And where can people get a hold of you or get in contact with you?
The best way is our website, which is the letter U, uDirect, IRA.com. We're on social media, like, for example, follow us on Instagram, uDirect IRA Services. I've made a lot of videos, like talking head videos, where I talk for 30 seconds about different points about IRAs. And there are a lot of different little nuggets that people would love to know about how to use a self-directed IRA. So you'll see that on Instagram, for example, but we're all over social media.
Awesome. All right. We'll link that in the show notes also. Links to uDirect IRA. Thank you so much for your time today. This was awesome.
Thank you.
Thank you. Thanks for joining today's episode of Invest in Rome. If you found value in this episode, please share it with a friend. New episodes dropping weekly. Like, follow, and subscribe. Until next time, I'm Dear No. Keep investing, keep roaming, and keep living the life you deserve.